Hey, Robert, how's it going?
Hey, Yaron. It has been a crazy week since we last spoke.
It has. Friday we get this inflation number of 8.6% annualized, and expectations were 8.3%. But the market responded as if this was a big surprise and as if it was much, much worse than anybody expected.
Well, I think it was. I both hate and love to correct you, but the annualized base just off of May was something more like 12% running. And it was the highest 1 month print since 1980, and there were only a handful in the great inflation of the 70s and very early 80s that matched that. So as we look at the headline number, it's always the trailing 12 months. So when you announce May 2022, you're essentially replacing May 2021 with May of 2022. And May of 2021 was a pretty high inflation month. There's something like 80 bips in a single month, which maps out to almost 10% annualized. And so there was the hope that it was going to come in lower than it had a year earlier, and that we would see another drop in that headline number. And so the fact that it didn't drop, but instead went up was a big difference between what people were hoping for in May of this year versus what we got. The inflation number came in at 1.1% just for the month. That used to be an entire year's worth of inflation,
Not that long
not
ago.
very long ago. And so it really was a big surprise. I'm not sure why it was unexpected given everything that I'm seeing, but it certainly was a big surprise. And it was reasonable to hope that the number would come in low based on the fact that we are comparing it to relatively high inflation. But things are not playing out to make this easy for any policymaker.
No, I saw today. I guess the PPI number came out, and it's again very high. It's not. So that's a producer price index. So earlier in the supply chain, prices are still rising. It's at amazing rates we haven't seen since the late 70s. I don't think people are completely have a realization of, so what is so bad about inflation, and why is it that markets go down so much when inflation is this high, or it's unexpected? What is it that markets are worried about?
Well, the biggest problem with inflation is when it's volatile. It's very hard to plan your economic activities, whether you're a producer, consumer, or for anybody. You're trying to plan for retirement. It's very hard if inflation is unpredictable. So ideally, you could have 1% inflation every year, and it varies between 0 and 2, and that's the world that it seemed like we were in. It would actually be reasonably good to just have inflation ranging from 3 to 5% every year. The trouble is, once inflation gets up, that it starts to distort people's activities in ways that can be self-reinforcing. And the biggest one that I think people should be concerned with right now is through the budget deficit. So we've seen a huge increase in debt around the world. And then you see and with that 0 interest rates, it's pretty easy. And in fact, in Europe, we had negative interest rates. So it's really easy.
I'm willing to borrow all day long at negative interest rates. Yeah.
And if it stays there, it's a stable equilibrium. But once it moves off, it becomes very unstable. And we're already seeing this in Europe, where they haven't started tightening. They're lagging the Fed, which is lagging reality. And they've already come out with, well, we're going to have to do something about the cost of debt in Italy and Spain and in Greece and the southern part of the EU. And that's where inflation really causes problems, because you can't keep rates low for Italy and control inflation at the same time, because somebody has to consume less if you don't want prices to rise faster. Someone has to be less interested in consuming. And that's that's where inflation really strikes at the heart of a productive economy.
So while Germany can afford to pay probably 3-4% on its sovereign debt, Italy probably can't. And when people realize they can't, then they add a bankruptcy premium to that. So their rates are not 3-4%, their rates are 8-10-12%. And now they really can't. And that's where in Europe, you get kind of a Greek financial crisis scenario.
Yeah, it's hard to imagine how things aren't going to go badly. I mean, there's still hope, but we've been living on hope now for a year, that if the supply side were to rationalize, we could just stabilize at this new price level, because arguably what we're seeing are shocks to the system. We had COVID, it was a massive shock to the supply system. Now we have Russia's invasion of the Ukraine, which is a shock. We have continued COVID, particularly in China, which plays a critical role in a lot of supply chains. So you've got these ongoing shocks that eventually, it's reasonable to hope that they will play themselves out. But there's been enough of a shock to the system that it seems clear that we're going to have to see a rationalization and not just wait it out. And that rationalization is the one that is going to be hard for a lot of economies, including, unfortunately, it looks like the US economy. We've acted as if we have unlimited borrowing capacity, and that's basically true until it's not. And then when it's not, it gets ugly really fast. I don't know if it will, but it's something that the Fed needs to be worried about, and that, ideally Congress would be worried about.
Yeah, and as interest rates go up, the government has to spend more and more money on interest payments on its debt, because they borrow short term. They tend to borrow short term rather than long term. So their interest rates are going to go up, which means they have to find the revenue in order to do that, which means greater and greater deficits at a time where you might want to be shrinking deficits. Yeah, so
the deficits, if you borrow the money, then you're just getting yourself into a self-reinforcing cycle, because now you have even more debt, which is at this higher interest rate. It only works when interest rates are at zero.
Yep.
Otherwise, it becomes a death spiral. And the tax side is the alternative to raise revenues is also tricky, because unless you've kept taxes low, there isn't a lot of capacity to raise taxes without creating economic drag, and then you're slowing growth. So you have this spiral, and the word for we use is stagflation, where you don't have enough growth to support the spending you want to do. So your choices are to either not spend the spending that you've promised, or to basically monetize it and add to inflation. So you get the worst of both worlds.
So inflation, makes planning very, very difficult. It makes investment decisions very, very difficult, because you just don't know what your dollar is worth and what it's going to be worth a year from now. So, and when inflation is volatile, you have no idea what's happening. But so that creates real economic harm. But then the other big economic harm, which I think markets are responding to, is the response to the inflation, which we're seeing from the Fed, and the uncertainty around that. So what's that about?
Well, if you can nip these kind of things in the bud, and we don't have enough economic cycles to say exactly what that would look like or how you would do it. It's not like the Fed has a secret formula and they've just decided not to apply it. But if you can, it's a lot less painful, because once inflation and rates both get high, and right now everyone's talking about 3.5% on the 10-year as if that's high, but you don't have to go back that far to say, no, wait, we could double that and it still wouldn't be high, and we could quadruple it and we'd be still below the peaks of the early 1980s. So once rates get high, inflation and in particular bond rates, then you end up in a different sort of straitjacket, because you're selling bonds that are, in the early 80s, there were double-digit percentage, up to 15% on a treasury bond. You're selling those to investors that are going to be collecting this interest for 30 years. And now if you disinflate, it's basically the opposite of monetizing the debt. You're demonetizing the debt. You're paying a real interest rate of what might turn out to be 5 or 10, or if you get inflation close to 0, 15%. So it's a huge net drain on I don't, on public finance. And so it's very hard to get out of the high rate scenario without a lot of pain. But if you can nip it, we still don't have high rates. If you could create a path, and I'm not talking about a soft landing because I don't see any way that there isn't a recession as part of this. But if you create a path where you leverage the fact that we're starting from very low interest rates, that we have a very robust labor market, and you just take the pain of getting to positive real rates, so you're not being accommodated anymore, and the supply cooperates with you, you could see rates, stabilizing at 5% with inflation at 4% sometime in the next 12 months, and us never getting into that bleak scenario. But that would be the place that's the scenario you really want to avoid. That would be the critical factor in every decision if I were a policymaker that I'd be making, because right now we have it so easy compared to where we might be a year from now.
And of course, you could make that easy by doing things to promote supply, which means doing things to promote trade, doing things to promote production, doing things that smooth out the supply chains. And I don't see where that's coming from. I don't see policy initiatives. There's actually, it's funny, there's actually a shipping bill that both the House and Senate passed. So it's bipartisan. You always have to be worried when something passes bipartisan. And it's shipping bill. So you'd think, okay, this is a bill that's going to smooth out the supply chains. They're going to lower regulatory barriers. They're going to make trade. No, it actually increases regulatory barriers. It's good for exports, bad for imports, which is stupid.
Not going to help inflation.
No, and I think Biden is going to sign it today or tomorrow, and he's hailing it as an anti-inflationary thing. And of course, it's exactly the opposite, as always. But you just don't see out there the push to drive, versus the deregulation that actually happened in the 70s, that ultimately I think led to increases in supply that helped moderate inflation. You're just not seeing anybody talk about that across the political spectrum.
Yeah, and it's really unfortunate because it's the only way out without there being a lot of pain, is to see the availability of goods and services rise to match the demand for goods and services. It's the only way that you don't just increase prices and have people have less but pay more. And it definitely was a critical piece of how we got out of the inflation of the 70s. And it took a long time. And kudos to Jimmy Carter, who doesn't get a lot of credit because he had a terrible presidency, but he did start things that played in a critical role over the next 2 decades of moderating inflation while also allowing for robust economic growth. And it's certainly possible because that growth is part of how you moderate inflation. You get into a virtuous cycle, then it's relatively painless. We have a few problems relative to that. We don't find ourselves in the situation we were in 1980 right now. Interest rates are not high. Mm-hmm. The job market is not horrific.
Not at all. It's some of the best job market ever.
So we definitely have some time. It would be nice if we had started a year ago, so we had more time. But if there's no action to support the supply side, then the odds of a good outcome just go way down, because then you're just hoping. Now, the action could be as simple as getting out of the way. I mean, if you think about from an Ingenuism perspective, there is no plan that's going to solve inflation. There is no initiative that's going to come out of the Biden White House that is going to take care of all these problems or solve supply chain issues, because whatever the issues are today, they're going to be different next month. So any plan you come up with is just going to, even if it works initially, it's just going to hamstring you later.
Well, the things you can do to lower the barriers.
You have to get out of the way, and then that's what we're not seeing at all. The shipping bill is a good example. I mean, the opposite would be something like repealing the Jones Act. Yeah. That would make a big difference, and that would be a strong signal. The other side is, of course, we're seeing it over and over in the petroleum industry, where oil prices are high, so gas prices are high, and all the policymakers seem to be able to do is bitch about the fact that prices are high, and not even realizing that their bitching is part of why prices are going to stay high. I mean, you declare war on fossil fuels, you shouldn't be surprised that nobody wants to invest in fossil fuels. Uh, you write a letter to refineries saying your profits are way too high. That's really going to encourage them to invest in capacity to produce more gasoline and other distillates, knowing that their profits actually should never be that high. I mean, it's almost as if these people have never held a real job in their life or had to create value or even understand the process of creating value. It's almost like Joe Biden has been a career politician who has no fucking clue what he's doing. Almost.
Oh, wow. Or Elizabeth Warren, I know.
Oh, yeah.
One of these. I mean, it's stunning. Yes, he did write a letter today to the refiners. And I looked, and there's been almost no building of refinery capacity over the last 10 years, 20 years. Not in my backyard, all kinds of regulations. And then, of course, the demonization of fossil fuels that has gone on, and basically said, you don't build because we're going to take you out of business anyway. So why would anybody invest in that?
It's been a very, very clear message. And now it's like, hey, turn on the spigots. No, it's invest billions of dollars to have more capacity in 5, maybe even 10 years, depending on the regulations that hamper the development. And oh yeah, in 5 or 10 years, we're not even going to let you sell gasoline.
So you mentioned before that you doubt that a soft landing is possible. Soft landing being solving inflation without a recession. So what are the dynamics that cause a recession in as interest rates go up? And then why do you think it's not avoidable?
Well, interest rates going up in general is going to benefit savers and hurt borrowers. That's just a tautology. And so the net effect, if nothing else happened, is just moving money around. You know, people are paying, instead of paying negative real rates of interest on their debt, they're paying higher rates. Positive real rates at some point is almost a necessity. And of course, there's a healthy risk premium. And it's that risk premium where you really see where value gets destroyed and how you end up in a recession. So right now we have an economy that has been designed and optimized on having very low interest rates and low inflation. And an increase in inflation starts moving money around. You know, refinery owners are making more money, and trucking companies or airlines have less money because the relative prices have moved. All right, well, that in itself isn't a problem, except for we've also, because it's when you optimize in a low inflation, in particularly low interest rate environment, you end up with a lot of debt. Is now you have that debt over time repricing, becoming more expensive. And for the refineries that have debt, but also now have massive additional profits, it's no problem. But for the trucking company or the airline, I'm just thinking of who uses the outputs of a refinery. I'm not pointing specifically to those industries, although I do think they're going to have problems. But across the board, there are people who are not going to benefit from higher rates and higher inflation. Businesses that aren't going to benefit and are going to be hurt by higher debt costs. And they're going to go bankrupt. And then now you have businesses, if they're small, they basically just close. If they're large, they have to be restructured, and that eats up between 10 and 25% of the enterprise value. They're just real costs in transitioning the economy from zero interest rates, zero inflation, to high interest rates, high inflation. And so as the Fed raises rates, and the Fed has been talking about raising rates for a while now, but is only getting started. And the Fed has been talking about not buying, taking on supply of federal and federal agency debt, not buying the government debt that's coming out. And now they're finally doing that. It's actually this month that the Fed has stopped replacing the debt that matures on its on its balance sheet in its entirety. And the numbers are large. We're talking about $500–600 billion a year of stuff they were buying last month and they're not buying this month. And of course, last month they were just replacing what was maturing, while 3 months before that they were actually adding $90 billion. So you've got this massive swing of something that's close to $2 trillion in flows annually between where we started the year and where we're going to finish the year, assuming the Fed holds on tight to its plan.
So that has the effect of sucking money out of the economy, of taking money off the table.
And just taking, there's a lot goes on, because if that's holding on its balance sheet, then where is it financing it? Is it? So there's a lot going on, but very clearly it means rates go higher, because you've got this massive buyer who's totally price insensitive that leaves the market. And we're seeing it, rates go up in a way that we haven't seen in decades. And we have bonds performing worse than stocks, even though stocks are performing terribly. And the entirety of it is that the way that we were producing things and consuming things, all of the optimization that people have done in their individual businesses and then in aggregate across the economy, is going to have to get reworked, and there's going to be a lot of pain. It'll be a lot less if we can peak out at 5% interest rates and 4% and get down, but that would require getting down to 4% inflation somehow. And right now, it's hard to see the catalyst for that.
So all of this is having a huge impact on the stock markets. We saw a massive decline Friday and Monday, a little bit of a respite the last couple of days. We'll see what happens. We're speaking on Wednesday, June 15th. So the Fed is about to announce how much they're going to raise interest rates, but they haven't yet. So it's going to be interesting to see how the market responds to that. But taking a longer term perspective, how much more pain do you think there could be in the markets? And from an ingenuous investing perspective, what does somebody do in this kind of environment where things look pretty bleak?
This is a great example. We always talk about how ingenuism applies to everything. And this is a great example of how ingenuous principles are just not that useful. They're not very useful for the Fed, because the Fed doesn't have the luxury of experimenting with a bunch of different monetary regimes and figuring out which one works. And there isn't a lot of history to base, if there are only a couple of legitimate possibilities, then you might be able to test them out and learn from that. But the Fed is flying to some extent blind without it being a repeated game. And investors, it's the same thing. I think that, personally, I think that investors have been extremely optimistic about a soft landing. For me, a soft landing would be a moderate recession. And you see that in the commentary, where you get jobs numbers coming out and the jobs numbers are strong, and people start talking about, oh, this means the Fed is going to be actually able to raise rates, as if there's another option. The Fed, either the Fed throws in the towel on inflation, and I promise you that would be way worse for the stock market in the long run, or the Fed sticks to its guns regardless of how much pain it's going to cause, knowing that there will simply be more pain if they don't stick to their guns. That doesn't mean that they will, but I think there's a good chance that I haven't seen anything out of the Fed that suggests that they are not going to take dramatic action now that it's clear that hoping things are going to get better, it was not a solution. But we'll see. We'll see some evidence today, and we'll see some more next month, and we'll certainly see in the fall. But for an ingenuous investor, you'd be looking at, where are the opportunities long term, and what are we going to learn? Not today, because today we're at the very cusp of this transition into a different type of economy, hopefully modest interest rates and inflation, but possibly high interest rates and inflation. But as we leave zero rates, how quickly can we learn where the opportunities are? And, can we learn a little bit faster than the the market as a whole, because there will be opportunities. It's just really, it's much harder to predict them when the pot gets stirred as much as it has been.
Yeah, so one of the sectors that's been hit particularly badly because of all this is crypto. Bitcoin, I think, was down to close to 20,000 today. What's going on? What do you think is going on there? And is this a complete rethinking of the whole kind of crypto space, and Web3, but also fintech? Is this a time where venture capitalists are going to rethink all of this?
Well, I hope so, because I think it's going to be warranted. But I think that it's certainly, there are positives and negatives to what's going on for crypto, both in the short term and the long term. I mean, if you think about crypto as being more than just an online casino, then you have to think about where's the source of value. And although it's something like Bitcoin, it's hard to see. It's not impossible, because we do see things like gold or even the dollar that have value, even though they are essentially virtual. I mean, they have no obvious inherent value. And once you take that paradigm, and it hasn't been a very popular paradigm since the whole meme stock world showed up a couple of years ago. But if you think about the actual value that's being created inside of a crypto or a protocol or a company, then you have to think about the timing of when that value is going to actually accrue. And regardless of whether you're talking about dividends, you're talking about utility value of being able to use something, the opportunity cost is higher when inflation, and particularly when rates go up. And so once the Fed was on a rate raising trajectory, it was very likely that Bitcoin was going to take a big hit, because if you hold Bitcoin, you are either putting it into a lender who will probably fail, or you're just holding Bitcoin like cash. And cash is pretty attractive alternative in a zero rate world, but it's pretty unattractive when bank accounts are paying 4% or 5% or 8%, which is a world that we certainly may be headed to. And of course, if we are going to be there in a couple of years, that means that prices should reflect that right now. So the opportunity cost for crypto has gone up, just like it has for all technologies. But then we also have the entire crypto ecosystem, which is just fleshing itself out. I mean, we talked about the Luna Terra crash, but you need stable coins to have a working economy. You can't have a working economy where the main currency goes up by 50% or down by 40% at any moment. And so that's going to be something that really benefits from the increase in rates. I mean, a business model like Tether, where you're essentially an ETF. You take people's money and you pump out tethers, and you keep their money in money market instruments so that you're fully asset backed. And then people use the tether to transact. But most people, it's just like we trade dollars. We don't go to the Federal Reserve and say, hey, give me gold. That was in the olden days, in theory, you could do that. And in an ETF, if you decide, well, I don't want to own, ARK stocks anymore, you don't go and say, give me my money back. You sell it to someone else. But then you have arbitrageurs, you have institutions in an ETF or in Tether that are able to cash in and cash out. So if Tether goes up to $1.01, they put a bunch of cash in and take the tethers and then sell them for $1.01, having just bought them for $1, make 1%, but make it instantly. So Tether stays right around $1. Well, the Tether business model, to actually run Tether, is a real challenge in a zero interest rate environment, like a lot of financial services, because you basically have the float. You can charge some fees, but really what you have is the float, and the float's been close to zero. So there's been a lot of speculation about what has Tether done with the money. And of course, Tether has lent the money to other crypto exchanges. Tether has, there's been some really risky stuff that's gone on. And that's almost a given that you have to do that if you want a viable business model when rates are zero. You have to make your money somewhere. And so with rates rising, real stable coins, truly stable, transparent stable coins become possible. And that's a necessary ingredient for a healthy crypto economy. And of course, flushing out a lot of the fraud and Ponzi and crazy ideas is also eventually needed to happen. And it's almost always in a downturn and not during the boom times.
All right, good. Well, we'll see what happens later today when the Fed releases its number. We'll see what happens in the weeks, months. It's going to be, if nothing else, interesting.
It's going to be wild. I think it's going to be a wild ride, and this will be relevant even when people are listening to it, because next month we talked about inflation at the beginning. Next month we'll be replacing June of 2021 with June of 2022, and June of 2021 was the highest month of 2021. It's basically the highest month since 1981, and that could be a decent print. But then it gets really ugly. If you look at the later summer and early fall of 2021, you had normal inflation where,
0.2 points.
Something very low numbers that would have not raised any eyebrows at any point in the last 10 years during the zero inflation environment. And so either something has to give, either supply has to start cooperating, or the Fed has to slow things down really quickly. Otherwise, late summer, August, September, it's going to be really, really ugly from an inflation perspective. If we want to make a bet whether we'll get a print that is 12-month lagging double digits, I would say we probably will, and that it would be September.
September, yep.
And that's, I almost wish it would happen, because I'd like to see how people react to it, because it's sort of predictable, but it would also be just gobsmacking for all of us.
Yes, let's hope we're all prepared for that.